That cooler than expected November CPI data this hour, and as a result, stocks are off to the races. This is what we had anticipated would happen if you got a softer than expected number. It was 0.1% versus the 0.3% that had been estimated. As a result, you've got the Dow futures up by 730 points, S&P futures up by 114, and the NASDAQ up by 458. Of course, everybody wondering what this means for the Fed and beyond. Liz Young is the head of investment strategy at SoFi. Liz, we have heard repeatedly from different Fed watchers, a former Treasury Secretary this morning, all of them saying, beware, because just because this number may be softer than expected, that doesn't mean that the Fed is going to ease up anytime soon, that this is a much longer play. One number's not going to make the difference. What do you say to that?
Well, that's right. And look, there's things in this report to certainly be happy about. It's working. It's moving in the right direction. We're definitely still far from what a target rate would be and what the terminal sort of satisfaction of the Fed would be. But there are things to celebrate here. And I do think from a market perspective, this could actually take us through the end of the year with some optimism. Now, the point here, though, is that if you look at what's happened in the VIX over the last couple weeks, it's risen since the beginning of December, which means most market participants are expecting that there's probably some more volatility on the horizon. Maybe it doesn't come until January. And what I think we'll hear from Chair Powell tomorrow is not so much about him trying to manipulate a market or move the stock market in a certain direction, but we'll hear from him about what his job is, which is to control prices and make sure that the labor market is healthy. And I think he's going to just reiterate that that job is not done.
Well, if that's the case, and I realize you're not a short-term trader, you're a longer-term investor, but when you're talking about 2%, 750 points, that does make a difference. If he's going to come out and talk tough tomorrow, does the market reverse these gains that we're seeing right now?
It might reverse some of them. And look, we've seen this happen so many times over previous Fed meetings. The most dangerous time to trade is between 2 p.m. and 2:30 p.m. when he starts talking. But I don't think that we're going to hear all that big of a new message from him. The big risk to the market right now, and probably through the end of the year, is that where valuations are. When we look at the end of yesterday, we were at 17.5 times forward earnings. That's above the 10-year average. Those conditions are priced for basically an easy monetary policy environment, which is clearly not what we're in. So the risk is to valuations here, and I don't really believe that we're going to be able to sustain that much more multiple expansion. The risk to the economy is that as inflation falls, we can celebrate it as it falls, but at some point it might get stuck, and it's likely to get stuck above where the Fed wants it to be, and then we have to try to decide whether or not the economy can withstand that.
So do you dip your toe in here? Do you wait? I mean, even people who are longer-term investors are thinking about that right now. Is this the beginning of the end of, the most extreme moves by the Fed?
I do think this is the beginning of the end of the most extreme moves. I would expect a downshift tomorrow and them to sort of slowly come off this big hammer of tightening. But I would wait this out a little bit. Look, I think, again, we could probably see some optimism and staying afloat in the market through the end of the year because there isn't that much more that's going to happen after tomorrow from a data perspective. But I think once we start 2023, we'll have more clarity on when does that terminal rate actually arrive and where will CPI and when will CPI actually abate before taking a big bite out of the consumer and out of businesses.